One of my clients who I took over, he had his property for 10 years and he sold it at a loss 10 years later just to get out. He obviously got the one that didn't move. A lot of others did. Pay the right person to give you the right advice where they're a specialist in. People just turn up and just say, I want a self-managed super fund because it sounds cool because their friends have got one.
Sometimes I get a call and speaking to a doctor and where it's like, oh, you know what? I think the property prices will start to increase because the interest rate just came down. Can you please set an SMSF? I'm going to go apply for the loan next week. Well, hang on, it doesn't work like that. Sometimes it takes about 2-3 months to even establish an SMSF because there's so many steps to go through it.
It's not that self-managed, right? Because you need other people around you to help you manage it.
That's where I think self-managed super funds are absolutely magic. It's not for the faint-hearted, but if you get the right advice, it can be incredibly valuable to you.
Hi, everybody. Welcome to another episode of the Investing for Doctors podcast. I'm your host, Dr. B. And today we have two guests back again with us, Nafees and Roger. So for those who've not met you before, can you give us the quick 2-sentence introduction about who you are and what you do?
Thank you, B. Thank you, Roger. Good to be here with you guys. My name is Nafees. For those who don't know me, I am a partner at KHI Medical. I am an accountant by profession. And I come with about 15 to 17 years of wealth of experience behind my belt from large and mid-tier practices throughout my life. And what I do on a day in, day out, planning, structuring, tax, advisory, accounting. And of course, we work with other advisors within the group to best provide the best solutions for our client.
Yeah, okay. Strategic accountant. Now, Roger.
Good morning, B.
Morning.
Thanks for having me back. Yes, I'm a financial advisor, planner. As we spoke last time, they are exactly the same thing. Been providing advice for coming up 25 years now. Run Smart Start Financial Services and Investing for Doctors, financial planning. We're going into a new realm of more strategic planning in association with accounting, with the fees, of course.
Yep.
For the more sophisticated clients such as doctors.
Absolutely. So the reason we have both of you here today is that we're going to talk about SMSF or self-managed super fund. And self-managed super fund is a humongous topic that we could probably spend a whole day discussing. But today we're going to keep it sort of nice and easy. And we talk about the very start of the start and the creation of a SMSF.
Of course.
All right. And how that works. And, we'll have, a bit of a discussion about who should be getting us SMSF, why you're getting SMSF, and how that is created, and how the both of you through your respective services can help their client achieve what they need to be. So before we start, SMSF stands for Self-Managed Super Fund. What is a SMSF and why is there this SMSF thing?
Of course. As the name says it, Self-Managed Superannuation Fund, right? So superannuation in Australia is very similar to 401k in the US, which is a mechanism to build up your retirement wealth and to provide you with an income after your retirement, which they call it pension in Australia, right? So an SMSF is basically a self-managed retirement fund. So what it allows you to do is to roll over your superannuation. So as an employee, an employer need to contribute, it was 9%, now it's all the way to 11.5% of your gross salary
and will be 12%.
Into a superannuation fund, which will be 12% going forward from next year. And also, of course, we will touch base on it a bit more. There's various other contribution that comes in. Essentially, the idea of it is that you have the option, you can have the superannuation in an industry fund and let a professional fund manager look after it, or various superannuation managers that are out there to manage it, or you have the option to manage it yourself.
Okay, so it's like having a fund that does it, at scale, but not customizable, versus you doing it yourself, nearly endlessly customizable.
Essentially, that's correct. And of course, as Roger will say, there's a lot of things you can do in a self-managed super fund that you cannot do outside in an industry fund as well. Because in an industry fund, you're regulated by the rules of a specific investments, right?
Yeah.
Where the SMSF gives you a bit of a flexibility to do various things.
Yeah. Roger, what is that?
Well, my biggest thing with explaining to clients what an SMSF is obviously it is a self-managed super fund, as Nafees said, means you self-manage the fund. So you have to consider, do I have the capability and the skill sets to make the investments on my behalf and my members' behalf, whether that be your wife or whatever. You can have up to 6 members, maximum of 6 members. So do I have the expertise to do that? And also you have to be the trustee. So the two big things that you've got to consider: do I want to be a trustee and have all that responsibility of keeping the fund a regulated fund? And I deal with the ATO, because self-managed super funds report back to the ATO or administered by the ATO, where the other types of funds, being industry funds and public offer funds, are administered by APRA. So you have to be able to understand, do I have the capability, and do I want all the responsibility as a trustee, and do I want to put other people who are coming into the fund, give them that responsibility as well? So it's a big thing to consider. I think they're fantastic in the right space, but yeah, a lot of the time, and Nafees and most accountants will agree, people just turn up and just say, I want to self-manage super fund because it sounds cool because their friends have got one.
Yeah.
But
is that your experience, Nafees?
I get that a lot. Right? Or I have X amount of money. Can I, buy property in an SMSF, or can I go leverage in an SMSF, right? And that's when the question comes in, well, you know what? I don't know if it's right for you or not, right? So that's when we team up with Roger, wealth manager / financial planner, whatever you want to call it, but to kind of provide the right advice, to sit down with the clients, to go through their assets and liabilities, their goals and objectives, to work out whether if it's right mechanism for them to.
So where do you find where do you think the point of entry is? Is it often at the accountant side, or do you find that they often come to you first, Roger?
Well, historically, it has been accountants, but now it's more, you have to go to a financial advisor and have that discussion. You can have a discussion with your accountant as well, but I'd go to a financial advisor and have that discussion about, is it right for me? And and the advisor will say, well, what are you trying to achieve? What do you want to do with that self-managed super fund? Because with self-managed super funds, you can buy a property that you want to buy, like a direct investment retail investment property or a commercial property, which you can do. And they're probably the main trigger points. If you'll get your heart set on that, and you do have some experience in that area, then we'd take that conversation further. Yeah. But if someone just says, I just want one, I give them a rundown of all the responsibilities that they would have, and say, well, you've also year on year you've got to get the fund administered and audited. And that's where you'd partner up with an accountant, because they do that on the ongoing basis. We don't. We help with the investments and what have you and structure. So we work hand in hand. So we set them up first, then the accountant looks after the administration of it going forward. Doing the admin and the auditing and what have you. But still, you need to make sure you understand what you're in for. And I'll just add to that. With when people want to buy property, generally they need to borrow money. Yeah. Now, if you go to a bank and just say, I just want to borrow some money, the bank's going to say, well, where's your statement of advice from your financial advisor? So these are the type of things you have to really work with professionals. Like, as I've always said, I go to the dentist to get my teeth worked on. I don't go to the mechanic to do it. You go to a professional, like a doctor, whatever. So, just my word, it's not a warning. It's just think it through. What your outcome is what you want it to be. Then you should read up all about the roles and responsibilities. And the ATO has a paper on the website which you can download for this very reason, because the ATO wants to make sure it's right for you. Yeah.
And is that I see that sort of the advice around that has changed quite a bit over the last couple of years. That's correct. Yeah. It sounded like back in the days there were a lot of people getting completely unnecessary SMSFs.
Oh, absolutely.
And now they're sort of trying to rein in on some of that at the creation stage.
That is why the role of financial advisor is very important, right? To kind of sit down with the client and go through, the pros and cons. As Roger has said, SMSF, it's a lot of headache, a lot of paperwork, right? Yeah. And that's what we're here for, to assist the clients in order to, navigate through all that as well. Yeah. But it is not as simple as just sitting there creating a fund and get go.
Yeah,
There's
it's
a lot
not
of
that
process.
self-managed, right? Because you need
That's
other
right.
people around you to help you manage it.
That's correct. You know,
And-
sometimes it takes
yeah.
about 2-3 months to even establish an SMSF because there's so many
Right.
steps to go through it, right? So
Yeah.
that's very important. Sometimes I get a call. You know, the other day I'm speaking to a doctor and where it's like, oh, you know what? I think the property prices will start to increase because the interest rate just came down. So can you please set me set an SMSF? I'm gonna go apply for the loan next week. I'm like, well, hang on, you know, it doesn't work like that, right? So
Yeah, that's jumping
you
the
know,
gun
we
a
need to
bit,
kind
yeah.
of step back. It's
Yeah.
a very step-by-step methodological process, but at the same time, if done the right way, it can be a very rewarding way of doing things, right?
And we often hear that, you know, there's certain things that you should not get an SMSF for, and there's obviously certain things that you can
you need
consider
to.
or
You
you
need
need
to.
to
That's right.
get an SMSF for. I mean, you know, buying a property under your super fund, that's the only way to get it. Essentially, you can't buy a property under SMSF, you know, with funds from your super,
Yeah.
without SMSF.
That's right.
That's right.
Yeah.
That's
So
right.
do you
Yeah,
find that is the
that's right.
most common trigger
Yes.
for it?
It is.
Yeah.
As a group, we look after about 600-700 SMSF, right?
Yeah.
And you know, and out of 600-700, probably about 90% of them are property investors. Property has been the backbone of wealth building in Australia, right? Traditionally,
Yeah.
right? And property is something that people knows, and so naturally, people are inclined to get property through an SMSF. And as Roger has mentioned, you can borrow in SMSF. So, you know, leverage to grow is the way to go. And of course, this mechanism like LRBA, limited recourse borrowing arrangement, right? That needs to be in place where the trustee borrows on behalf of the fund. Right.
It gets complicated.
And yes, that's right. So it's not a straightforward method of just setting up a structure and ready to go because essentially an SMSF need to have SMSF trust. Ideally, the trustee is a trustee company to limit the risk. And then you've got to have a borrowing entity called a custodian company or a custodian or a bear company, bear trustee company. And then also once the property has been found, you know, depending on the what state, you would also need a bear trust deed as well. You know, so that can add to the cost of establishment, of course.
So that's
and of
like
the
4
paperwork.
structures right there.
That's correct.
Yeah.
Two trustee companies and two trusts. Because
Yeah.
superannuation is just a trust.
Yeah, of course.
But also the bear trust is it's two.
And-
So it's, can be
and
expensive
if
to
you
set
add
up
in more property, each trust can only hold one property.
at a time.
So
Right,
you
at a
need a
time.
bear trustee and a bear trust.
No, the bear trustee company can be the same.
Yeah.
The bear trust has to be separate title holder for each property.
Yeah, so you need a separate trust. For
That's
every single
correct. So
property.
while the mortgage is going on, the title needs to be held in the name of in the bear trust of the property. It all gets reported in the superannuation fund from a tax point of view, from an overall members balance perspective. However, you know, just the title, because there's a loan against it, and technically a retirement fund cannot borrow, right? That's why this arrangement is done to borrow a fund through this mechanism.
Okay. So now, you know, I think we touched a bit about that. So let's go through the step-by-step sort of processes of the setting up and the thoughts and considerations that we have to go through to get to the stage of having SMSF set up.
Sure.
All right. So we'll workshop this scenario as we always do. You know, me being an eager beaver, I was like, oh, my friend did something. I've come to you in a face. It's like, oh, my friend's got a self-managed super fund. I would like one too. You know, myself and the wife, we got about $250,000 each in it, and I think we could use it to invest in either property or the stock market.
Sure. I mean, look, you know, it sounds
Yeah.
all great, and I know you are a client of mine. I do know what you have in your individual capacity and all not. You did mention that it is something that you'd like to explore. Of course, we can explore that. But
Yeah.
to do that, I think step one is to we need to sit down because I'm not a licensed advisor. You need to sit with a financial advisor for them to kind of go through your assets and liabilities and whether if it's right for you and provide this thing called SOA, Statement of Advice, right?
Yeah.
Once you get the Statement of Advice, then we can speak, right?
Okay.
Then we can go to the next stage, right? And ideally, you know, I would introduce them to Roger. If needed, we can have a conversation together, and then Roger will go ahead and, you know, do the process for SOA, where I believe, Roger, if I'm not correct me if I'm wrong, you'll ask a whole set of questionnaire to get to know them, to understand them, and provide your advice.
Okay, so now you've referred me on to Roger, the financial advisor, financial planner.
I'd like to introduce you to Dr. Payne.
This is the part where I get roasted. Yes.
That's it.
So I would like to self-manage super fund.
Yes, you get roasted, exactly. Well, first, look, there is a process, as I said. I'd really explore where your motivations come from, and it just. But in the same time, we're trying to get an understanding of your investment experience and the outcomes that you wanted to get. And when I talk about the investment experience, property. You might say I got 3 or 4 investment properties over here. And I go, okay, well that's a bit of a tick.
Yeah,
because you have some idea of the markets and you know what's involved in the purchase of cost.
Yeah,
of
say
property.
I've got 3, sitting around.
And then I'll say, well, okay, you got my attention now because they're usually overdone and oversold for people who don't want to do that. In your instance, if you say you wanted to do that, I'd say, all right, well, this is something. Bottom line is, if you want to buy property in your super, for a start, you have to have a self-managed super fund.
Yes.
You can't buy it in a retail fund or an industry fund. So that we just assume we've got past that. Then obviously to follow the typical financial planning process would be the fact find, the numbers, the assets, liabilities, all that type of stuff. We'll get all that boring stuff out of the way. But then obviously talk more about your goals and objectives, which we've touched on. And then obviously too, as Nafees said, I can give advice. I am a licensed advisor, so I can give advice, but I can only give that official advice in a form of a statement of advice, or otherwise known as a financial plan.
Yeah.
So I go ahead and I do I do a needs analysis on insurance as well, because your super fund can hold insurance, and that's one of the regulations. I can't remember what regulation it is in the SIS Act, that you do need to consider insurance in your superannuation as a trustee. So you've got that responsibility too. So that's why you need to work with advisors to, people would know. I didn't know that was a compliance thing that I need to consider.
Okay, so you have to have the insurance either already sorted or
researched, needs analysis completed, and what have you. In your case, you might have enough assets to cover your debts and what have you, but just say you don't. Insurance is just a tool to make sure that anything happens, the trajectory of your wealth creation sort of stays on track. So, but the bottom line is, a trustee of a self-managed super fund does need to consider the need of insurance for all members.
For all members.
Yes.
Yeah. So it basically means that, say, if I died and I was no longer contributing money into the super, and we had, say, myself and my spouse in the SMSF, then my death is not going to negatively impact on her and all those other things. Is that the consideration we're talking about?
Yes, that's exactly right. So it could go ahead and just say you cover the debt, whatever the debt may be, in that arrangement that you have, that it can be paid off within there. So the super fund can now owns the asset.
Yeah.
All right. And
of the life insurance asset. Yeah.
No. Well, the life insurance, because the super fund owns the life insurance policy. The insurance company will pay the owner. Which is the SMSF.
Exactly.
And then generally you get advice, of course, go ahead and pay off that debt.
Yeah.
And then without getting too technical, that bear trust will close down. The asset moves into the super fund because now it's not encumbered. It's unencumbered.
Okay.
I don't want to get too technical. But anyway, moving on for your story. So we just assume that you've ticked all these massive boxes, and I said, I think it's a good idea.
Okay.
And I do recommend we consider that, but I have to provide the advice in the form of an SOA.
Yes.
So I do a statement of advice, which is about a 60, 70, 80-page document, and it's considering your insurances for all members and all what have you. So we need to consider the other members as well. We need to consider all the other amounts of superannuation each member has sitting over in their respective funds.
So the more members I have, the more complicated your job is.
Well, the more work not necessarily complicated, the more work.
The more work it is.
Much more work. But then you get a bigger bunch of money to come in, because you can share that. You still have separate accounts within a self-managed super fund.
It's accounted for every single
Everyone has their own separate account within the umbrella of the self-managed. So you've got 3 members, each can roll their respective balances in. They don't have to roll it all in.
They can roll.
You'd generally roll the lot in. So 100, just say it's 100,000 each, 3 members. 300,000 comes in, so you can use that 300,000 for the deposit. Okay, so you can combine your money, and that's where business owners, business partners do that in a structure for their commercial properties. But again, we won't go down that path. So you've got the SOA, and I made the recommendation based on all those factors, and I think it's a good idea because I believe it's going to, you got a good outcome. Not just I believe it, my SOA has to show that you are going to be in a better position, and you have the ability to do so as long as working with me going forward. So then you take that to Nafees, and I say, well, I don't set them up. You go and see your accountant, Nafees, or refer you back to Nafees, and then he'd go through the statement of advice and say, yep, cool, let's set it all up. We know the structures we've got to do because we'd have all that set diagrammed out in the SOA. And then when you go to the loan, obviously you go to the lending part of the IFD business, and they will need that to take to the bank to see that you've been given proper advice.
Okay.
To set that structure up, and the cash flow and everything's been done, and it's been also backed up with an accountant.
Yeah. And so you would have set up all the structures, and then you take that structure and say, this is the structure we already set up.
That's
and
right.
Set up
to
properly.
the lenders.
That's right.
And
That's right.
then you would then give the statement of advice and
So the
match that up
statement of
together.
advice comes back to me.
Yeah.
I'll have a quick review through it. Let's just say, Roger, you've given it to me. B, I can see that Roger's advice is that, you roll over X amount of fund from your industry fund because, you'll have your life insurance in your new SMSF because, of course it's a better rate. But however, you need to retain a bit of funds in your industry fund because your TPD covers is better
Or
in
something
there
else
than you
is
might
in
get,
there.
right?
Yeah,
so you
yeah,
might
yeah,
need to
yeah,
leave
yeah.
a little bit of a fund,
Yeah.
depending on what the advice is, right?
Yeah.
And then you roll over the fund. While we go through the establishment of the structures and all that, we use a lawyer to do all the structures because we just want to make sure that every single box has been ticked off in the right way.
Yeah.
So while this process is being done, you'll have the conversation with the mortgage broker as well. And that's why it's important to have all the teams together working for you, right? So it's not just siloed just to me or Roger or or to mortgage broker, right?
It's all collaborative.
So while we work together, I might get into the conversation with the broker as well, saying, look, this is what the total balance is. This is what the employer contribution is. Okay, you know what? Depending on the lending, sometimes in a SMSF lending, you might need, the bank gives money based on the contribution, employer contribution, right? But some banks do accept, one of extra contribution as a top up to the margin, up to the concessional rate, right?
So you can each do
And considering the rent.
Yeah, rental income as well.
for instance. Yeah.
Depending on the yield of the property, it all comes back into play. So while that conversation is going on, it is very important to know that when you purchase a property, it cannot be in an SMSF. It cannot be rented up to you cannot live in it. You cannot rent it to your family, friends, relative. It has to be rented to a third party at an arm's length through a real estate agent.
Yes.
Right?
Yes.
And it has to
Another
be
misconception.
right?
People say, I want to buy an investment property in my super fund so I can live in it. No, you can't.
Yeah.
Forget that.
Or I want to rent it out to my, my brother-in-law or someone else. You cannot do that. It
So
cannot
how
be
related do you have to be?
Not related at all.
As in no blood relation, or
No
can
blood
it,
relation.
Can it be like some cousin-in-law third removed?
You could go that far.
It's like-
as long as it's through an arm's length.
says there's no relatives,
Arm length.
right?
Yeah. You're not,
right?
you
Still
need
an
a
arm's
family,
length.
obviously, no.
That's right.
Twice, once removed, maybe a bit more.
Maybe 2, 3, but the
Your
sister
nephew's
says
too much. Your niece is too much. Too close.
Well, that's only like one generation.
Yeah, that's right.
And,
That's right. That's
one
right.
intermediary.
So it has to be rented to a third party, right? The
Yeah,
definition of third party is defined in the SIS Act as well, right?
But the difference is that for a commercial property, that's the rules are different for that.
Commercial property, absolutely. If you have your own business rented from that, which in case of a lot of medical practices, that seem to do that. They buy their practice in the SMSF. However, the rules are very strict as well. It has to be an arm's length rental agreement, right? And the rent has to be paid as well. So it cannot be discounted. It cannot be this and that,
has to be
right?
commercial rate.
It has to be
It has to be
commercial
an
rates
commercial rent, and you need to have
actually
a
paid.
proper rental agreement lease in place as well.
Yeah.
Right. So it cannot just be a piece of paper say I agree to pay X amount of rent.
Yeah, you probably have to get a lawyer to review
That's
that,
right.
and
That's
then
right.
have it witnessed on both sides, even though it could be yourself.
That's
on both
correct.
sides.
That's correct. Like you need to have the proper
Do you need an
lease
agent for that,
documentation.
though?
The agent, no, you don't need an agent.
you don't
As
need
long
an
as you have it.
As long as you have an arm's length
and-
agreement and pricing.
That's correct.
And in your annual review, of your administrator, your as I said, fund's got to do a tax return every year.
Yes.
And be audited. You got to demonstrate that the cash flow and the auditor, apart from the admin within the accountant, first has to be satisfied and see the transactions going through from your statements and seeing the money flowing correctly and at the right rate and all that. And then the auditor has to be convinced that it's actually run properly as well. I can see the cash flowing properly and everything's according to the contract that you've written down.
Yeah.
But that's we're getting back to that we're going back down that path. That's where I think self-managed super funds are absolutely magic. They're fantastic because, just a tradie, even doctors, as you said, whatever, like a tradie can have a factory and say, I'm paying rent to Joe Blow down the road. Why can't I sort of bring that in sometime how to my structure? How can I do that with them? I've got no cash, but I've got a heap of cash in my super fund. Well, then you can set up a self-managed super fund with all these structures. If you need to borrow more money and what have you, then your self-managed super fund can buy that factory. Your business, registered business, can rent that off, as Nafees was saying, rent that off your self-managed super fund at a commercial arm's length basis. So you're paying rent. You're getting a tax deduction to pay rent for something that you're going to end up owning and retiring on anyway.
Yeah.
So it's a great structure for that. So if a self-employed comes to me with that and they got that structure, straight away I start thinking that works. That's something we need to consider because I will bring that up because that is a very good structure to have.
Yeah.
And that's something I'd educate them about to say, well, have you considered this because of those reasons that you can do? And you've got more control, but you still got to stay within, the arm's length rules and what have you. So that's where it's an absolute magic arrangement. Like myself and Nafees, we can buy an office. Our businesses can lease that off our self-managed super funds, and the rent is tax deductible to the business, and you're getting tax deductions.
As long as you work out the numbers and the numbers make sense, then it all makes sense.
And you can actually have a mixture of residential and commercial property in an SMSF, right?
And also non-commercial, obviously.
And the beauty of the SMSF is that the contribution, the income that the super fund generates, it gets taxed at 15%. The capital gains,
it's 10.
It's 10% with a 1/3 discount, right? So technically 6.5%, right? 6.66%, right? So it is quite lucrative. Whether you want to go through the commercial side of purchasing or through residential as well, right? And also one of the client I was speaking to last week, where he kind of drilled down in the fact that $200,000 balance, let's just say on a high level, not an advice, but that's a real life scenario that I'm giving $200,000 give or take with a good yield, plus 20% deposit plus 5% incidental. Let's just say buys a property of $800,000, right? Then $800,000 on a conservative market in a property market, let's just say if the property even goes up at 5% in value and gives a rental income of say $30,000 a year, right? Or $35,000 a year. Suddenly you have a $35,000 worth of rental income, and also he had the value, the growth of increased by 5%. That's another 40,000. That means his overall wealth has increased by about 40 plus about 30, 35 of rental income, about, $75,000, right? And that was his calculation that he achieved with an investment of $200,000. When you take 75 divided by 200,000, it's almost 40% plus return. Of course, there's interest, deductions, taxes and all that. Even if you take that all into account, the rate of the return is actually very lucrative as well, right? So that was the exercise we ran. Together. So that opened my eyes in different ways as well to kind of see what the power of leverage and what an SMSF can do with the right advice, of course.
So then the other question is that do you always have to nearly outperform industry fund for you to get an SMSF if there was no other purpose, such as owning your own sort of offices? Like when you have that comparison, does this make sense? What is the benchmark on comparing it? Is there has to be purpose, or is it just purely dollar and cents?
It's purpose. It has to be purpose, as getting at earlier.
So it's not just dollar and cents. If you have a purpose, but you sacrifice a bit of dollar and cents, but for future gain, that's okay.
As that example explains the purpose and with the right advice. And again, saying when Nafees was talking about the capital gains tax, concessionally capital gains tax, but once you've turned that in, once you say you've reached a condition of release, which is 60 when you're not working, or 65 when you're still working, don't need to get too technical with that. you turn that into an income stream.
Yeah.
Then it's in the pension phase, and then if you sell it in pension phase, there's zero tax.
Yeah. Yeah.
So there is a lot to do and a lot to consider and learn about this whole superannuation structure, because it's zero tax environment when it gets in pension phase. There's nothing better than zero tax.
Yeah.
It's the Cayman Islands, which is totally legal here.
Yeah.
And the government does mess with it a little bit.
I guess that's why they're trying to clamp down on it with the transfer cap.
Transfer balance cap of 1.9 million.
Yeah, I mean that's gone up. It started at 1.6, but again, the government wants to make sure that the retirees, the aging population, can self-fund to take the pressure off the government purse to pay age pension. So there is a massive incentive. So people say, oh, they change the rules all the time with superannuation. Yeah, they do, but there's still the main goal is to be able to incentivize you to be able to self-fund. So you take the pressure off the government's purse to pay age pension. So they're going to keep tinkering with it, but there's always going to be a really, really good outcome for you down the track. There always is, because their purpose is, as I said, to keep the pressure off the purse, because there's less taxpayers.
Yeah.
They've got an aging population, got less taxpayers, and then we get a whole new
you have a whole new demographic,
a whole new argument there
problem.
About
which is
and all that stuff.
Absolutely. And because
it's
we
all
are
doom and gloom.
because we are like a property centric firm as well, of course, it's really important to have a right buyer's agent as well, in terms of your selection of the property that gives you the best growth, right?
Yeah.
So, what I've seen with a lot of my clients is that, and I'm talking about the savvy investors only, right? Sophisticated investors, right? They can read the market in a sense that in around 2018, 19, they were all buying properties in Tasmania around that, $200,000 to $250,000 in value. By 21, 22, Tasmania prices have more or less doubled, right? So, they all decided to take that capital gains, pay that 10% tax. But what that gives you, a $200,000 investment suddenly, become $400,000. They get the cash out, pay a bit of tax. And around 2022, I've seen them go to Western Australia market, right? Because that's when they knew the next boom, is likely to be there as well. So, they're taking that fund, get into Western Australia, and now I can see them, moving out of Western Australia because, one can argue that it might have peaked the market, but that's a different conversation with a buyer's agent. But I can see the savvy investors are, slowly focusing the investment in other states where they think the next growth will be as well. So SMSF is a very good way to kind of to maneuver the market with a low tax
because the cost
rate.
of entry and the cost of exit is relatively lower.
Tax is very lower, right? So it allows you to do a whole bunch of things.
Well, as Nafees said, the importance of a buyer's agent is extremely important, because these are one of the figures that I just keep remembering from years ago of knowing a buyer's agent. She told me, at any one time in the Australian market, there's up to 355,000 properties on the market. 355,000 properties. You've got to pick the right one. If you go to the stock market, there's only about 2,000, around 2,000-ish listed. You've got to pick one out of 2,000 or one out of 355,000. I know who I'm going to get help me to pick one of the 355,000 is someone who's in the game 24/7, which is a buyer's agent. It's something I don't do because we don't delve into property directly. The numbers we do, but directly don't. When it comes over to shares and investment, we do.
Yeah.
But again, as I said, I'm just trying to illustrate the importance of a buyer's agent, because I bought a property. My wife and I bought a property through a buyer's agent in Adelaide, and I wouldn't have done it any other way. It cost me a decent fee, but I tell you what, the returns just blew the fee away. And the certainty of knowing it was a great growth area and all the fundamentals behind it that they give you. So it's just mandatory.
And I think I've mentioned in a previous podcast is that the margin for error in investing in property has just gotten so thin now that
every investment has pros and cons. Right?
I remember back in the days when I started, you could get one. Your yield, you could basically find residential property that was where the yield was at least the same, if not a bit higher than the prevailing interest rate of that time. And that was like, you could pick anything, hold it for 5 years, the rent would have gone up and it would be cash flow positive.
It's very different
right?
now.
Very difficult now. Now you're seeing people holding for 5-10 years and they're still negative.
I'm not telling you who. I got a client who I've wound up a lot of SMSFs because they were oversold by property spruikers. I'm not trying to put anyone, but there are good and bad apples in every industry. Some property spruikers were selling property in Queensland, which we've all probably heard about. And one of my clients who I took over, he had his property for 10 years in North Queensland, and he sold it at a loss 10 years later just to get out.
10 years.
I've had that situation. There's certain areas.
Yeah.
In a very nice, in the Whitsundays, I'm telling which town, but in the Whitsundays.
Yeah.
But it was just the wrong part of that area. You know, it's like I said, that 355,000, you got to pick the one. He obviously got the one that didn't move, and a lot of others did. So, you know, you got to be careful and get some professional advice and pay for it. Just pay for it because it pays to pay.
Yeah.
It certainly does. I paid an agent.
And get the right people, obviously.
That's what I mean. Pay the right person to give you the right advice where they're a specialist in.
Yeah.
Yeah, I got asked the question actually a couple of days ago. A client asked, look, you know, I have engaged a buyer's agent, but the property that I got sent is the same property that I've seen in realestate.com. I'm like, yeah, that's fine. You can see the property can be available on realestate.com that you get.
But the thing...
But
would you have found the realestate.com if the person didn't bring it to you?
There's about 50 other properties in the same area.
Exactly.
Why did he pick that one?
Yeah.
There's studies behind it. There's a research behind it.
What's the
There's
fundamentals?
thing, right?
Yeah.
So that's, I mean, look, at the end of the day, you know, as I said,
don't know
it's
what
an
you don't know.
individual choice as to whether you like it or not, because a lot of people, they tend to do their own research and, you know what they're doing and things, you know. Buyer's agent is a very good way, especially for medical professionals.
Time poor.
Because time poor. That's right. That's right. Everyone's so busy, and it just takes the research and the headache away. They're not 100% accurate all the time, but you do get the best.
Minimize risk.
Minimize the risk as well, right?
Yeah.
In that sense.
Yeah.
I just want to clarify, when I say there's property spruikers, I am not talking about buyer's agents.
Oh, yeah,
Because
yeah,
a buyer's
I know.
agent represents you,
That's right.
me,
Yeah,
the
yeah.
client.
Yeah.
Spruikers want to sell these, they just get rid of junk.
Yeah. So there's obviously
Just wanna be clear on that one.
the typical ones where it's, you know, off the plan, and
They act on behalf of the buyer.
they are acting on behalf of the seller, really.
Yeah, well, that's the spruikers.
The
Buyer's
spruikers
agents
doing
are for the
it.
buyer.
Yeah.
You see them in the malls and stuff,
Yeah.
the property spruikers. But
Yeah.
and a buyer's agent works for you and you only at that point in time. For your needs and fundamentals, your numbers, they find the right number. Don't worry if it's a green door or a pink door.
Yeah.
As long as the numbers are right.
Yeah.
That's what they work on.
And I guess coming from a financial advisor perspective, especially when you're putting things into self-managed super funds, you want the numbers to make sense and not the emotional side.
That's what we do is the numbers. As I said, we don't pick the property.
Yeah.
But we work with numbers.
Yeah.
And what numbers work, because numbers are numbers. Numbers don't lie.
Yeah.
So the numbers work. And as Nafees would say, accountant, numbers work. But then the buyer's agent's got to find the property
That makes
that's
that
got
numbers
to
work.
fit those numbers, and it actually fits the growth profile.
Yeah.
And it's going to got that potential for growth and good income, and you know the fundamentals behind it.
Yeah.
You know, the growth
Obviously,
in that
nothing
area.
is
And with the
nothing
range of
is for
strategy,
certain.
that's
But you know,
right, that's right.
But you're minimizing risk doing that.
But you got to start off right,
Yes,
so that
that's
you
right.
you have the, you know, you risk mitigate against things going wrong.
So when we sit with a client, right, and it's not just a SMSF, right? They have individual other structures, maybe other investments, businesses, and various things, right? It's a great tool from a tax planning perspective as well, right? So you might, you know, run a business where you take $150,000 in wages, you know, you contribute 16,000 in your super fund. In our tax planning meetings where we sit down, we say, well, can we do a personal contribution, right? To get it to the maximum concessional cap of 30,000. So you get the deductions.
Yeah.
You can have this thing called, if your total super balance for each member is under 500,000, you can actually go back 5 years and do a carryback contribution.
Yeah.
When is a good timing for carryback contributions, right? I had a conversation with someone yesterday where they wanted to go do a 5-year carryback contribution, but their 2025 current year income is actually a little bit lower, where the 26 I know will be, you know, almost double. The high tax,
the timing
tax
of it is
bracket, right? So I said, look,
important.
you know what? Let's just do 1 year, 2021 or 2020, and carry it forward. Maybe next year in July, do the balance of it to utilize, all the way to 2025 as well. So these are the plans and strategies that you need, because in one end, you're saving as a company 25% tax, you're paying 15% tax on the other end. That's a $10,000 savings. 10% savings right there. And if you're an individual sole trader, medical practitioner, you're 47.5% tax bracket, right? Including Medicare levy, versus 15%. that's a big gap right there as well in savings as
It's
well.
arbitrage, yeah.
Yeah.
So with the right strategy and moving the funds at the right way, it's a great mechanism to build wealth, and you're not just limited to one property. You can add in, as long as your servicing and everything meets up, you can add in more.
Yeah, I guess the take home is that it is a different structure. It's a tax privilege structure.
Yeah.
There's a lot more rules. There's a lot more compliance. But it is, you got to treat it as another structure that has certain, bells and whistles attached to it.
You're considering you're running a business.
Yeah.
Because you got to take your
investment
mindset. You got to have that mindset that you're responsible, because the buck stops with the trustee or the director of the company, the super fund, which is generally it's the director. The director is a member.
Yeah.
Of course, we recommend you get corporate trustees for protection and what have you. But the buck stops with you. So you got to think, I'm taking this on like I'm running a business. So am I up to it? Do I want to?
And do you want to have that responsibility
and if you want to,
for the other members?
Yeah, but that's exactly right. And you can work with an advisor. I have lots of super funds I work with, and so does Nafees.
Yeah.
So you can still do it with the support around you.
Yeah.
But you still got to understand, even if we stuff things up, which we don't, the ATO will come looking for you, not us.
Yeah.
That's right. And if there's a breach in the super fund rules and regulation,
what happens then?
The members' balance can be taxed at 47.5%. Right.
Of the asset value.
The asset value, not the contribution.
Not cash.
Oh, right.
Total members' value, balance value gets taxed at 47.5%.
So if there's $3 million in there, you get taxed 47%
And
of $3
if
million.
it's not liquid, if it's just a property.
Yeah.
That's right.
If the asset, not cash.
That's
asset.
done. That's done.
So you've got to get it right.
Very important. Yeah. That's why. Of course, it's governed by APRA. Of course, you need a good strategic accountant around it. Of course, you need it to be audited as well. And the auditor actually files a report saying that it's compliant, and that report has to be submitted in time as well, right? Because there's a lot of penalties and other things as well if things are not done in a timely manner as well. And then at the same time, we need the right financial advisor as well to make sure that they have gotten the right advice to have the right strategy, right?
Okay.
Every year or so, we need to update the strategy, fund strategy as well, right?
Yeah.
So that's very, very important as well.
Of compliance, yeah.
That's right. So it's not just as simple as just buying a property and just let it grow for the fun of it. It's
You got to work on it. You got to
treat it like as Roger has said, treat it like a business.
Yeah.
But it can be amazing, very rewarding way of building your wealth and portfolio.
The
as
irony
well.
about that is a super fund cannot be seen to be on running a business, which is quite ironic. And you got to get an ABN anyway. If your listeners are thinking, yes, I do have a self-managed super fund. Of course, I do.
Do you have a self-managed
Yes, I
super
do.
fund?
I do.
All right.
And I know a lot of doctors are going to say, "Oh, I've already got my rooms in my name. Can I put them in?" Yeah. If they're a commercial premises, there's a thing called an in species that you can do that. There are things that you can do. There is. Bottom line is you can do it.
Yeah, but it'll be a contribution.
No.
In-specie
It's called an
transfer.
in-species
Yeah,
transfer,
but
but it
I
will
think-
trigger CGT.
Yeah, so it will trigger CGT, but then
There is concessional
duty
on
as
stamp
well.
duty.
there's
There's discount on stamp duty.
there's discount on stamp duty, but I think the value that you transfer in also has to meet
Market
certain
value.
market value, and also does it impact on your non sort of concessional contributions or whatnot?
No, it will be purchase of an asset, right?
Beautiful.
It will be purchase of an asset. It's a net value of the asset.
It's in species. It's not a contribution.
Yeah.
So doctors out there listening, I'm doing one now for a couple of doctors where we're transferring his rooms into the fund, and there's a lot of messing around, but in the long run,
It's going to be way
it's
better.
way worth it. Because as I said, in retirement phase, he could be leasing, because he's retired, he can lease them out to the next generation of doctors coming through.
Yeah.
In pension phase, drawing an income, or if he sells it, it's no tax.
Yeah. So in that situation, the super fund will then pay the doctor's personal name, or there is no transfer of money at all. It's just like a transfer in.
Sorry, say that again.
So when you do this transfer,
The in-species transfer.
so you're transferring assets into the super
fund.
Does money have to come out of the super
That's right.
in return?
It's a sale. It's a purchase by the super fund.
If the fund doesn't have the money.
Yeah.
Yeah. So we are having to set up an LBRA structure.
Yeah.
So we're transferring it, but it's the money's coming out to pay him what's left over. And
Yeah.
the fund now has got a loan.
Yeah,
under that
right,
structure.
right.
But I was just assuming there's no money owed or anyone. There was enough money in the super fund to just
Yeah, so if there
That's
was
It
the-
has to
money,
meet the servicing
That's the-
criteria.
yeah. So if there was a $500,000 in there and the property was $500,000,
Yes.
you could just like whoop.
Yes.
transfer.
That's right.
yes,
Beautiful.
That's
yes.
right.
That is. I think that.
So you're not getting. It is a sale, but it's a transfer. But you're like getting money out of super. No, well, you're putting that
Yeah,
asset in
yeah.
there. You're just swapping.
Yeah, and the from a taxation perspective, that's actually
It's a capital
You
gains.
could actually
Not too bad.
do it in species in that scenario. You can do it in species and or purchase because it's
Yeah.
the same thing because you're still going to crystallize the CGT.
Yeah.
and you still will get the stamp duty concession.
Yeah. Okay. So the stamp duty concession is usually
Concession,
the,
yeah, which
yeah,
That's
is
the
usually
big
what
one.
you get.
yeah, that's the
So
big
that's
sale.
$750.
And as I said to
Here,
you,
New South Wales.
it also improves, could be improving your serviceability because now that
Absolutely.
you've kind of offloaded one of the property and the lending against it, where you have a bit of a cash as well for your other investments and structures
Outside
and other
super.
outside super as
Beautiful,
well. So it's a very, very
So you can pay some down your non-deductible debt.
That's right. That's right. So you can actually have, because if the super fund has paid you for the sale of the purchase of that asset, the cash is on you now. You have to pay the CGT with that cash the superannuation gives you for
Yeah.
that sale of the thing, and of course
Yeah.
pay off the mortgage against it. But then you've got a leftover balance which you can use and a free up borrowing ability that allows you to go and
Sure.
purchase other assets
Yeah.
as well.
Okay. That's I think that's
So it's a
pro
great
tip.
tool, great mechanism.
Absolutely.
That's a pro tip. Yeah.
not an advice.
No, it's a pro tip. That's
It's
right.
just general speaking.
Yeah, that's right,
that's
Generally
right,
speaking.
that's
Awesome,
that's
awesome.
right.
So, I guess to wrap this up, I think you gotta have to start off a self-managed super fund. You gotta have a couple of prerequisites. You gotta have an accountant. You should have a financial advisor.
I think first you'd have a purpose.
And
That's right.
Well, yeah, and then you need to have enough money and
Yes.
also a purpose
Yes.
that is valid for the intents and purposes. of having it.
Valid to suit your needs and your purpose. Yes,
Yeah.
because if you're just not interested in any of those type of assets, you're just happy with
Beautiful.
bonds and cash and manage funds and what have you. Why would you want to become a trustee? All that responsibility.
Yeah.
Well, you can still in retail funds, you can still have a myriad of selection. I build a lot of portfolios.
Yeah,
I'm not restricted, and there's no responsibility for the client as a trustee.
beautiful.
Yeah, we call it the cost versus benefit analysis. So
Yeah.
we look at after a certain balance, right? The cost to maintain an industry super fund is more or less the same as to maintain SMSF.
Yeah.
right?
Based on value,
based on the
balance. Yeah.
value, right? So that's when we know, like, okay, look, you know what? It could be a time to kind of explore that idea. If that's something they want to do. But
Okay.
the flip side is that the cost that it takes to establish the structure, it is a deductible in the SMSF, and that money can be reimbursed back to the member that has paid for it, right? So the members paid for it upfront, and the super fund can reimburse the fund back to the member because it's a cost of the super fund to be deductible to in the super funds.
Okay, awesome. Lovely to have the both of you on this today's episode, and we look forward to more discussions on self-managed super funds because there is a lot more.
A lot to talk about. There's a lot of things you can do. It's a really cool structure. But again, it's not for the faint-hearted. But if you get the right advice, it can be incredibly valuable to you.
Excellent. All right.
Absolutely. As I said, it's been the bread and butter of wealth building in the generation before myself, in the previous generation and in the current generation. It just has to be done in the right way and within the rules, and then it could be really great and rewarding overall.
Beautiful.
Excellent.
Thank you, gentlemen.
All right.
Pleasure. Thanks, B.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial investment or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.